Welcome to Chit Chat Money. Before we get to the interview, we have to throw a disclosure out there. So each of our guests owns a position in the securities that we discuss. Asher Delug is a co-founder, but he is no longer a director or an insider.
Of Mohawk Group, the company we're talking about.
That's right. And Sean Emory is the CIO of Avery & Co. And Jonah Lupton is running Lupton Capital, an emerging managers social capital program, and we are general partners at Arch Capital. So basically, this is informational purposes only. We're not making any recommendations.
Yes, we do not hope from this video to get the stock to go up or down. It is purely informational.
Exactly.
Take with it what you will. There's no, it's like Ryan said, it's not a recommendation. It's just information, and it's just people talking about the stock. Make your own decisions. Don't listen to anyone else about what you should do with your portfolio.
Without further ado, here you go. Okay, today we are welcomed by three different guests. So we've got Sean Emory, who our listeners are probably familiar with, Jonah Lupton, and Asher Delug. Asher and Jonah are new to the show, but a little bit of background on everyone. Sean is the founder and CIO at Avery Co. Jonah Lupton he runs Lupton Capital and a growth fund for social capital. I think I'm getting that right. And then Asher Delug is a co-founder of Mohawk Group, and he's on the board at Spin Launch. So before we dive into like the detailed discussion of the business, we wanted to kind of lay the groundwork, give a little background for anyone who's unfamiliar. So why don't we start with Asher, and then we can go around the room. Sort of, why do you own the company? And I guess for Sean and Jonah, how did you come across it? And maybe Asher, what were the early days like?
Sure. I'm a little bit different. I'm a co-founder, so I've been holding the stock for 7 years now, since the very beginning. I actually could have sold by now. I'm unrestricted, but extremely bullish on their business and their business model. So I'm a long-term holder. I guess the reason why I'm still holding it after all these years and plan to keep holding it is because it's not only growing extremely fast, but the growth is extremely repeatable and sustainable, which is something that, in my businesses in the past, every year, you're growing fast, but every year you're asking yourself, how are we going to do this again? How are we going to grow at this rate again? We need new levers. But in the case of Mohawk, it feels extremely repeatable, their model. And I think they can do what they're doing with these kinds of growth rates for many years to come,
Okay. Sean, what about you?
Yeah, no, obviously echoing kind of somewhat he said. Obviously, we are shareholders, and full disclosure of that. And we're not making any recommendations here, but we are trying to kind of articulate our rationale and the story. We think, stepping back, how did we find it? Obviously, so we try to look at all the IPOs, roadshows once they go public. I actually remember Yaniv in kind of what seemed like a little basement, kind of pitching the story digitally. And that was the first time I heard of it. And honestly, it was a compelling kind of idea, but to be quite honest with you, it seemed a little early, and the overall model didn't necessarily reflect maybe the potential opportunity. Fast forward a couple of years, we think they're starting to grow into themselves as an organization. When we look at kind of investments, specifically structural growth investments, we really focus on kind of 5 key pillars, which is management, growing market share within that market, margin, potential expansion, and multiple expansion. And they kind of hit all those criterias in terms of what we're looking for. Online's growing. We're seeing that it's 30% of kind of total commerce. Asia, it's 50%. And we think both of those are still early days as kind of the foundation of online commerce continues to evolve and scale. And many of the companies that are building out the infrastructure are less than 10 years old. And then growing market share within kind of these marketplace models. We think if you think of the legacy models, they're really around people sitting around a table and procuring products and putting them into brick and mortar and essentially kind of a really top-down approach. And you're kind of paying for physical shelf space. And the marketplace model turns this on its head. It's really consumer driven. It's shelf space, digital shelf space, and it's really predicated on reviews, rankings, and Mohawk sits there trying to optimize for the consumer. Amazon's trying to optimize for the consumer. So there's an alignment there. And ultimately, we think this is a compelling story just based on their success of organic product development, along with this new acquisitive strategy that they've been taking on over the last 6 months. So all in all, we think this is an interesting story as they continue to go down this path of growing into online commerce and the marketplace model.
Jonah, I know they kind of hit all the points, but how did you come across it? And then feel free to add anything.
Yeah, so I mean, out of the three of us, I'm the newest one to the stock. I've been in Mohawk since early December. So last year, 2020, I was focused on larger companies. I had a big position in e-commerce stocks. I was in Shopify. I was in Etsy. I was in Farfetch. And then towards the end of 2020, I started transitioning my portfolio to small caps and mid caps. I just thought that some of these large cap names had run too far too fast, and we were going to start to see some multiple contraction. So I wanted to start adding some smaller names to the portfolio, did some screens, talked to a few people. I actually had someone mention Mohawk to me back in the summer when the stock was in the single digits. I just never took a hard look at it because I had such a big position in Shopify and Etsy and so forth. So, once I made the decision in, let's say, early Q4 to start transitioning to small caps and mid caps by the end of the year, after I took a deep dive on Mohawk and actually did a Substack write-up on the company in mid-December, I've been adding to the position ever since. So Mohawk is right now my fourth largest position in my personal portfolio and probably second or third in my social capital fund, because I've been adding a lot to the position. I don't have much cash in my personal portfolio, but I did have some cash coming into today in my social capital fund. So I've been adding to Mohawk today as it's pulled back under 29. So, like both of these, both Asher and Sean said, I just think the story is pretty interesting, especially at these prices, this valuation, the combination of launching products and growing them organically, combined with the accretive M&A strategy. Right now the stock's trading at, let's call it 30 times EBITDA with the 100% top line growth. I don't see much more downside from here.
Okay, now we're going to get to more the specifics of the business. We're really going to focus on how they can grow from here, because that is a big part of Mohawk. We'll start with Asher, and then if anyone wants to follow up, please go ahead. How do you see the product mix expanding over time? Is it going to be more through acquisitions or organically through new product launches?
For the next few years, I think it's going to be mostly M&A. I think M&A will eclipse organic. Keep in mind, organic's going to still grow extremely strong like it has been since we started the business, like clockwork. But the M&A is just so overwhelmingly large, the roll-up opportunity in the near term, that I think it's going to give the direct product launch a run for its money. But I think probably the way I think about it beyond direct versus M&A is, these are totally complementary strategies. When they acquire a new company, it gives them a beachhead in a new vertical to go ahead and launch tons of new products from there. So, the M&A is just ultimately amplifying their direct product launch business.
Okay. Anyone else have any follow-ups? Maybe we'll start with Jonah and then we'll move to Sean.
So I do think right now, I don't know exactly how fast organic is growing. They don't really break it out that clearly, but I do think the bigger opportunity is going to be on the M&A side. So I've never actually shared this, but 5 or 6 years ago, I was living in North Carolina, running a web development company, and I met with a couple other entrepreneurs, and we actually talked about doing something similar to this. We just thought there were so many of these smaller e-commerce brands out there that were looking for an exit. Someone started these companies with a couple friends. They grew it to $5 or $10 million. And, you're not getting acquired by Procter and Gamble. So, how do those founders actually exit the business and, get some liquidity? And that's where Mohawk can be there to step in and buy these very attractive, still growing businesses, generating free cash flow at attractive multiples, chop out some of the overhead or unnecessary expenses and costs like people, and make those businesses even more profitable than they were before. So I think going forward, the M&A strategy is what's going to attract more institutional investors to the story. But I think, the organic growth and launching products is kind of like the icing on the cupcake.
Sean, anything to add?
Yeah, I mean, not much. I think it's just echoing the fact that, look, there's new categories coming up all the time. And within those categories or keywords or product listings, there's really an opportunity to organically create something. And kind of they take that approach from the bottom up. Then you talk about the acquisition strategy. And if it is this accretive, and look, we speak with Amazon sellers quite often, and speaking to single kind of product or single brand and very successful, you actually recognize just how much help they actually need on the technology side and kind of the know-how of managing their supply chain. And these are companies that are successful on this platform. So that's essentially who they're going up against on the product side. So organic or through acquisitions, it's really improving the products of kind of the example that I'm talking about, or essentially just building from the ground up, and even building products for over the next kind of 2, 3, 4, 5 years for other marketplaces that I think we're in the early innings of seeing play out. So that's really my kind of 2 cents to add on everything they already said.
And I think that early innings point is important, because even though we saw the acceleration of e-commerce last year during the pandemic, this whole e-commerce thing is just getting started. I mean, I know people, including my parents, that really didn't do anything on e-commerce, including Amazon, until they had to last year, and now they're addicted to it. So, and I think there's a lot of people. So the fact that, and I know some people like to poke holes in the story, saying that they're so, Mohawk is so reliant on Amazon. I don't think that necessarily has to be a bad thing. I mean, Amazon's the largest, most powerful e-commerce platform on the planet. With 150 or 200 million prime customers, I think the fact that Mohawk is aligned with them is a good thing.
Yeah, and I guess on the acquisition side, how do you? And we can start with Sean on this, but how do you think about the dilution? Because a lot of these acquisitions are done or financed partially with stock, and so they're kind of using that as currency. Is that something you like at the current valuation? I mean, I guess, is it a concern for you at all, or would you prefer that?
Yeah, look, I'll take that in 2 ways. It's really the form of funding and also the acquisition kind of strategy itself. And when you look at the terms of funding, obviously equity is the most expensive form of financing. So I'd rather prefer the cheapest kind of funding possible. But I think what we're seeing is 2 things. Is one, an improvement in financing, right? We saw their latest deal, the size of it, and also the reduction in interest. So I think that's something to kind of put in your pocket, but also we have to keep in mind where they've been. So if you just step back, you look at most credit decisions are based on kind of like 12-month trailing. And the last 12 months is really the first time they squeaked out any sort of profitability. So we have to understand where we are, but more importantly is where we're going. So when you look over the next 12 months and you see the potential guidance that implies X level of profitability, we can assume that there's not only a product flywheel that's happening here, both organically and through acquisitions, but also one through financing and a financing flywheel as they improve this platform. And I think from a margin standpoint, that's going to be highly accretive at some point in the future. On top of that, I think it's important to understand that this Mohawk probably went public maybe 2 years too early. This was, if you look at them right now, they're probably primed to go public right now if they were private. Just hitting profitability, just scaling the business. And ultimately, I think people are kind of thinking of Mohawk, given that they've been public for so long, and then comparing kind of financing structures. This was very similar to a private equity like financing, a late stage financing. And ultimately, I think that's where the business is. However, yet, if you think of where the business is going, I think, again, that flywheel on the financing side starts to make some sense. Now, the dilution comment that you mentioned, yeah, there's equity dilution, but it is accretive. So it's important to understand that they're financing this business through dilution, but using a higher valued asset to buy or lower valued assets. Therefore, just in simple terms, the total asset in itself is we're lowering the overall value of the conglomerate in a sense. So I think that's an important distinction when you're talking about using dilution to fund something and seeing that return on that investment. So that's how we look at it. Again, it's about finding the cheapest form of funding, but again, putting some context around where this company is today and where they're going.
That's a good point. That most recent financing, 8% debt with warrants does look sort of similar to what you would get with a private company doing a venture debt deal. So,
Asher, anything to add to Sean's comments?
Really interesting comments. I will say, as far as 2 years too early, it does resonate. It was definitely a debate at the time about bringing the company public, and it was a rocky initial go. At this point, I do feel, despite the pullback, we're in a great place. Around that $1 billion valuation, but it does resonate overall, the comments that perhaps we went public a bit too early.
And then just in general, in terms of how they're doing deals and, whether or not I like that strategy. I do, because of the price tag of the deals. They're only paying, I think on average, let's call it 3 to 5 times EBIT, I believe was the Healing Solutions deal. And, the stock is obviously trading at significantly higher than that. So if the stock was trading at 30 times EBITDA and they were doing deals at 30 times EBITDA, I wouldn't necessarily like it. But I think the strategy, the fact that they're buying companies that are already proven and profitable, and they're buying them what seems to be like a discount, because those companies probably don't really have any other form of liquidity or exit, which is obviously a good thing for Mohawk. So I like it. I don't know if we're going to see any new product launches in the near future. I guess I hope we do, but only if they really see big opportunity in that particular category. Otherwise, I want them to double down on the M&A strategy.
Yeah, Asher, you got your hand up there.
Yeah, just another point on the M&A, which has been talked about a bit, but obviously it's super accretive, even at the 3 to 5x type of multiples that they're looking to pay. Some deals have been less than that. I think there was one at 2.5x. But I think the real number, when you look retrospectively in a year from now, is going to be more like 1 to 2x when you factor, all the cost synergies and all the ability to enhance top line, new product launches, as well as SKU optimization for existing products. I think that's going to be a big wake up call for the market too. That people are talking about, perhaps the multiples will rise over time. But in reality, when you look back on these multiples, they're gonna be even, not just a little bit, I think much cheaper than the headline number that we're seeing right now on these deals, which is still very low. Yeah,
I'll add one thing too. I think that makes a ton of sense in terms of what Asher is suggesting, and taking it one step further is really trying to understand why they're buying. I think when you look at the technology that they're trying to build, and there's more to that, right? This unified approach. Look, at the end of the day, this company was built to create products where they thought there was gaps, and there was kind of an opportunity to slide in as a product or category leader. And for them to make an acquisition in a category that they feel that they cannot necessarily become that first page of a search result, I think says a lot about what they're actually buying. And the longevity of that digital shelf space that's being acquired here. So I think we can assume that what they're buying is leading position, and we can assume that these products can have an extended shelf life, which implies that a 2 to 4x. And then again, if you use the multiples Asher was just using, we can assume that these investments will be highly accretive as time even goes on. Again, that's an important distinction to make in terms of what they're buying and the perceived moat that they're suggesting when they make this acquisition.
Okay, we'll move on to the next one unless, Ryan, do you have a follow-up? Or are we good?
I was just going to, why are they able to make these acquisitions at such cheap multiples? Is it just the companies they're buying don't know where to go from there? I'm curious why they're able to make such cheap acquisitions.
I think you're right. I just think there's a lack of liquidity in those size companies. I've heard So when I started a couple of e-commerce companies 6 or 7 years ago, I talked to a friend that was in the M&A space, and he said, don't even think about getting acquired until you hit 10 and 2, 10 million of revenue, 2 million of EBITDA. Like he said, that anything below that, and there's no buyers for you whatsoever. And that was 5 or 6 years ago. Those numbers may have come up even more. So, if you're an e-commerce brand doing 10, 15, even 20 million of revenue, you're just not really big enough for anyone to acquire you and make any impact to their bottom line. So I just think that's where Mohawk can, really capitalize on these smaller brands and do this roll-up strategy of companies that are doing, kind of 15 to 30, 20 to 50, maybe somewhere in there.
Yeah. Asher, you got something?
Yeah, I agree with Jonah fully. Fabrice, I believe it was Fabrice, actually addressed this on, I believe, the last earnings call. And one important point he was making is that from the perspective of the seller, it's way more than 3 to 5, whatever they're talking about on the headline multiple. The reason why that is because the seller, they have a extremely unoptimized capital structure. They're pouring a lot of that money right back into inventory and marketing. So when you look at their actual cash flow and their distribution activity to the founders, is honestly at times, I'm sure it's probably zero, if not, much smaller numbers than the 3 to 5x. So, the EBITDA that they're valuing it on. So huge spread between the actual cash flow and what they're talking about on EBITDA multiples. Exactly. I think Fabrice said, by the way, 1 second, I think Fabrice said, I forgot the number he used, but I think he quoted, effectively it feeling like 15, 20x to the founders. Sorry, go ahead, Sean.
Yeah, no, I was kind of say some of that, but it's the working capital. It's really all about working capital. And these sellers can't take the capital out of the business because they need to continue on. So they either keep selling or they don't. So it's either taking all your EBITDA and running away, or you're getting multiples of that EBITDA and running away. Now also you're seeing that the complication of trying to launch multiple products or multiple brands across multiple structures, which ultimately talks or kind of emphasizes the need for technology to be that solution. These sellers are really archaic in the way that they're doing things. They're using point solutions like Jungle Scout or Helium 10, which are good solutions in itself, but it's not unified. So it makes it really, really difficult for them to scale beyond what they're already doing. And then now they're being asked to move international and kind of do other things. And now you're having the commercialization of this platform where somebody like a Mohawk or a Thrasio or many of the other vendors that are out there that are doing well, that are essentially competing against them. So if you're a seller right now, and again, I've spoken with plenty and I can see underneath the surface what it actually looks like. And it's clear why they would sell in this environment. And it goes back to everything they just said.
Okay, Brett, feel free to ask the next one.
Yeah, so we covered this a bit, so I'm going to just pivot it slightly. Is there ever a point within the next few years where they can fund, say, either acquisitions or just new product launches through their operating cash? Do you see that as a path within the next few years? I guess we can start with Jonah on this one.
I mean, maybe smaller deals they probably could, but I mean, the way I look at Mohawk is, as they generate more cash, pay down debt, strengthen the balance sheet, they'll be able to refinance that outstanding debt at cheaper rates. I mean, I think if they're going to grow and capitalize on this M&A strategy, I think they're going to still want to do it with debt. They're just going to want to do it with cheaper debt without the warrants. So I don't know if they'll actually end up paying for deals straight off the balance sheet, or they'll just, keep leveraging up with cheaper and cheaper debt as the balance sheet gets stronger. At least that's how I look at it. Okay. I mean, they're not, unlike Microsoft, right? Microsoft bought Nuance today for $16-17 billion of cash because they have like 100 or 150 billion cash to spend that anyone wants to do with it. So I don't see Mohawk in that position anytime soon. So I think the goal for them is just to get the cheapest debt possible.
I guess, would you guys like to see them add debt to the balance sheet. I mean, if you're looking at like the past 12 months, it looks like they're just going scorched earth, like acquisition after acquisition, because they're finding these great deals. Would you like to see them kind of continue that and accelerate it with some debt, or would you rather it be done through stock?
I'd rather see it done through debt.
I agree.
Sean, any thoughts on that?
Yeah, no, I mean, like I said before, it's wherever the cheapest form of capital is, that's what you take. And I think that flywheel will continue as this product portfolio continues to expand. So yeah, I mean, that's my 2 cents on all that outside of everything I said.
Okay.
Perfect.
Keep in mind too, that they are using stock as well. It's not purely debt.
Yep.
Yeah.
Okay, we're going to hit a quick break, and then on the second half, we'll try to hit on the competitive advantages.
Bring up some counterpoints as well, yeah.
All right, welcome back in. Next, we're going to hit competition. And so this is the one I was really hoping to ask.
This is the fun part, yeah.
Yeah, we have a very collectively a smart bunch here. So I guess we'll start with Sean, but how hard is this model to replicate? And then Amy, which is their artificial intelligence engine, sort of helps power the marketing side and
The acquisitions.
more as well. But how much of an advantage does that give them? Because we know there's other companies out there that are sort of doing this as well.
Yeah. So yeah, to replicate this, I mean, it's really, I alluded to some of it earlier, but there's the operational level kind of requirements that is you need to have to kind of build a product to scale across the marketplace and therefore marketplaces. And then second is at the underlying individual product. So operationally, if you think marketplace sellers will continue to kind of commercialize these operations really across many categories, single marketplace, and eventually on multiple marketplaces, then I think you have to believe that a unified solution on the technology side will be required, right? Because again, you have to have something that is allowing you to speak from your support to your marketing to your inventory. Today, again, it's point solution. So there's technology kind of or operational intensity that is required. And that in itself is not necessarily the norm today on these platforms. So Mohawk is 6, 7, 8 years ahead of the curve in terms of building that solution and having what I would call a systems advantage, especially when you compare it to the average seller, which is the average kind of seller that's on these platforms. And then on the product side, it's the fact that each underlying product is highly fragmented. And again, this comes down to the product level. So they're able to, or they're competing against each product at that product level on a keyword or a category. And what we're seeing is it's really, really hard to move, and Asher would know, it's hard to move off a category leader. And I mean like the first 5 or depending on which category. Otherwise, and as evidence is, we would expect then a company like GE would essentially be at the top of each appliance category. They have the most money, they have the best brand. So you got to ask yourself, why aren't they the leader? Why aren't they the leader of each category and each keyword? And really it comes down to reviews, ratings, and rankings where you're optimizing for the consumer and really building out a valuable listing that has that digital shelf space that's sitting in that category. And ultimately, when you think about it, so it's operational intensity. If you really believe that the commercialization of these marketplaces will continue, multiple marketplaces, which will make it even more complex. And then at their product side, you can take out one of their products, but you can't take out 1,000 SKUs or 2,000 SKUs. And what does it look like 5 years from now if over the last 6 months, they've gone from 250 SKUs to 1,000? So that's kind of how we think about the replication of kind of building a consumer packaged goods for the digital world.
That's perfect. Asher, you may have your hand up there. Do you have any follow-ups on that?
I actually didn't mean to have my hand up, but I do.
It's okay. It's okay.
Yeah. So I think the market greatly underestimates the delta in technology between Mohawk and some of these other guys that are popping up. For years we've thought about hey, we should go roll up e-commerce brands. This is not a new thought. But why has the company only done that over the last year? The reason is because we never thought we were ready. We could run 1,000 miles per hour and start acquiring them and turn into a federation of brands, which I believe is what these other companies are currently. They're just a federation of disparate brands. For us, we were always focused on the centralized full stack e-commerce platform, full automation. And that, took time. And the concept, for example, the deal we did with Healing Solutions, they onboarded thousands of SKUs in 48 hours. That is insanity. Like that was our dream for years, to be able to do that. And before the company was ready to do that, it felt like, if you're going to keep ingesting SKUs, we knew from experience, if you're going to keep ingesting SKUs, you're going to create an operational nightmare for yourself, because for every deal, you're going to need more customer service, more marketers, more every link in the chain, just throwing more people at it. If you look at the revenue per employee or just employee count growth of Mohawk versus, some of the high profile competitors that are popping up, that tells some of the story. And I've also been hearing just in the industry that some of these other aggregators are becoming sort of like, 200-headed monsters with, acquiring these companies extremely fast, with no centralized tech and ops platform. And it becomes this nightmarish federation of brands. That said, I think there's going to be a lot of great winners in the space. I think there's a lot, they're going to do well, but it will take a lot of time for them to get to the place where Mohawk is now, as far as that centralized stack. And who knows where Mohawk will be in those few years, because God knows they're working on the next generation at this point.
Jonah, any follow-up there?
They both have some great comments, so I'm not going to add too much. But I think when Mohawk got started, they wanted to build a, tech-enabled CPG company where they think about the tech first, the platform, like Sean said, kind of the unified approach, the logistics and all of that, and then bring in the products to layer over the top. And I think too many other companies have done it the other way around. They start with the products and then try to figure out the tech later, and realize, they've put themselves in a messy situation where they just can't manage that many brands and that many SKUs. So I think Mohawk had the right idea from the beginning, and now that they've got everything set up, now they can start digesting these acquisitions.
So I guess my follow-up there would be, if Amy's viewed as the competitive advantage, is that something someone could go out and do the same thing, or does that get better with time, where now that Mohawk's been doing it and had so many different acquisitions, the Amy software continues to sort of get further ahead of the competitors? Am I thinking about that right, or is it still sort of replicable?
Asher's probably the right one to answer that.
It's what I say. It's a 6 to 7 year head start is a very significant head start. And not only that, it's the data and experience they've had in that time. So yeah, like I said, I think there's a lot of great companies that are going to catch up eventually to where Mohawk is today on tech and ops stack. But I wish, I'm no longer an insider, obviously. I wish I could see their roadmap for Amy and the platform. I don't know what it is, but I can guarantee you it's impressive. It is. I remember, years back when I was still, we're at the company every day. The roadmap was truly endless. It felt like a roadmap that could never be completed. There's just so many hooks, platforms, angles that and I'm sure it's grown. So my guess is that they're just going to maintain their lead. And I think Mohawk, they may not be the leader in some other aspects. Like, some of the competitors have raised more capital, and it's impressive. But I think Mohawk does have, first of all, I think they have the same access to capital as the competitors. But their technology advantage will be forever, in my view.
All right. Anything else? If not, I'll move on to the next one. This one, and correct me if I'm wrong here, and we can just move on. But one thing that came up when we were looking at it is, why does Mohawk license out the AMI software? We were looking this up, I think a few months ago. There was an article on that. Would you rather them keep this in-house? And I know it's a tiny part of the business right now. I guess we'll start with Asher. You may know more about that.
Like you said, it's a extremely tiny percentage of the business now. Yeah. I know, though, they've said publicly, and, they have some senior positions at the company that indicates that they, are working on something bigger with that. All I will say is I trust management that whatever they do in that space is going to be A, worthwhile, and B, non-competitive with their core business. So, I think there are ways to do it. For me, it's not something I'm overly excited about. It's show me the money. If they announce one day that they've a super interesting deal on that end, that'd be great. But I'm like Sean and Jonah, I'm looking at, how much M&A can they do? How much direct product growth can they do?
Okay. So it's not the core story. Go ahead, Jonah.
Yeah, I'll ask a question to Asher. Asher, do you think AMI is more important for which side of the business, for identifying opportunities and categories, or for identifying M&A targets?
I mean, I think the identifying part, that's, what we call prospecting. That is whether that is just one tiny part of what AMI does, right? Tiny. I mean, it's important, but it's a tiny, tiny part of what AMI does. So, as far as the prospecting side, I would say, well, I guess for the next few years, maybe M&A. In the long term, direct product growth for sure. But M&A, honestly, you don't need the AI-based system to do that. But the other sides of the other aspects of AMI, the automated marketing, which that alone, I feel like that could be a standalone business, like a really big standalone business. It is the best automated, digital ad buying system for e-commerce out there, in my opinion. It's unbelievable. Interesting. What they're doing on customer service with AI and tying customer service into the system, what they're doing with inventory management and logistics and fulfillment. There's so many of these areas that AMI touches. Prospecting is an important one, though.
So they are sort of using that, I guess, secret sauce, if you will. If that's sort of the background, that's what their big advantage is, and they're kind of just giving access to brands to be like, here, let us help you sort of optimize. Is that what that licensing part is?
To be honest, they haven't really announced. They had some. When I left, we had some small pilots. We had, frankly, some of the largest companies in the world asking to license AMI. I'm talking about top 5 CPG companies, multiple Fortune 500s. We never pursued it. Now, they haven't gone, maybe correct me if I'm wrong, Sean or Jonah, but it doesn't seem like they've given a whole lot of detail on that. I know that there was a public release on, I believe, like a private equity fund that they're helping out, or some sort of fund or financial vehicle that they're integrating with, but it's infinitesimally small at this point. Right. There's no, yeah.
Okay. I guess back to the acquisition side, and have Jonah sort of starting on this one. When we think about competition, if we see Mohawk's business model work out, I imagine there's going to be a lot of copycats that want to do something like this, which would make me think, okay, there's going to be more demand for these smaller brands, so maybe they'll be paying higher multiples. Do you think Mohawk will have to pay more of a premium to get these brands in the future, or is that kind of less likely?
I mean, there's a lot of these brands out there. So I don't know how many competitors there would need to be for the market to get so crowded where Mohawk was overpaying for deals. It feels like there's plenty of deals out there to be had. I mean, the name that always gets thrown around is Thrasio. I thought maybe they would come public this year, but they just raised another private round of capital. So I don't know if that means that they're going to come public later this year or next year, but my guess is we'll probably see them trading publicly in the next 12 to 18 months. I don't know if it's going to be an IPO, a SPAC, a direct listing. I mean, I guess we'll have to wait and see. But I mean, that's the one that Mohawk kind of gets compared to. Thrasio is definitely bigger. I believe they're at $1 billion, either 500 or $1 billion run rate. I think they just raised capital at 5 or 6 times sales. I actually know one of the angel investors, and he's given me all the numbers before. I just forget them off the top of my head, but I think they just raised capital at 5 or 6 times sales. And then Mohawk is trading at 3 times this year's sales, maybe a little bit lower than that now. So, I mean, that's why I kind of hope that Thrasio does come public, because I think it would be a nice comp for Mohawk and make Mohawk look a little bit cheaper. But I mean, just in terms of competition, I'm not really sure. I mean, I don't know. Maybe Asher or Sean can answer this question better. I don't know how many other of these roll-up companies are out there that have the sort of scale and resources that Mohawk has. But yeah, I mean, it's very possible that if Mohawk becomes a huge success or a bigger success than it already has been, that you could see some other players come out there and do this. Now, whether or not they started from scratch or what, I don't really know. I mean, Asher's been through Asher helped start this company, so I'm sure he can tell you that the early days, it was not easy to get going. Or maybe just, a bunch of guys get together and, raise some VC money and start sort of a CPG fund and go out there and acquire brands. And then I don't know. I mean, it'll be interesting, but I'm not too worried about it. I think there's enough e-commerce brands out there that Mohawk can run pretty fast for the next 2 or 3 years without having to overpay for deals.
Asher,
Yeah.
any follow-ups?
Yeah, I mean, a couple points on that. I mean, this has been talked about, but the market's gigantic. If you just look at the TAM, Sean would know better, maybe 300 to 400 billion. Just if you look at Amazon, right? Third party. But the growth of that TAM is, growing 40, 50 billion. Again, Sean would know these exact numbers better, I'm sure. 40, 50 billion per year. So with all the headlines we've seen about Thrasio and Branded and this company and that company, the total money raised is forget about the TAM. It can't even keep up with the growth of the TAM every year. Not even close. It's just dwarfed by it. I'm also hearing in the market that these companies, despite being, again, all the headlines of all these companies out in the space, it almost would feel like, wow, these companies are bidding against each other for e-commerce deals and it's this active market. It's not. They're barely bumping into each other out there. So the market is so big that these guys, with all the headlines, they're not even, I mean, I'm sure here and there they are, but they're for the most part operating in their own little bubbles. That's how big the market is. So
Interesting.
Sean, do you have anything on that as well? Or
Yeah, no, the market's huge, right? And at the end of the day, that's what it is. And some of the rough numbers that were thrown out are accurate, and it's growing, right? And we're also seeing the companies like Walmart turn on and really emphasize and even provide incentive to join their platform, which is a good thing for anyone that is subject to Amazon's marketplace. But if we're just looking at this marketplace, think about the competition. The competition is really single product sellers, single brand sellers, right? So we're talking about mom and pop type of sellers that are on the platform, and that's the bulk of them. The other side of it is if we're talking about the acquisition competitors, I think we have to separate it, right? There's roughly like 15 that are sitting out there that are making acquisitions both here and in Europe. And kind of decomposing that slightly, you have Thrasio, which does have capabilities internally, meaning they're hiring people that are operationally savvy and to lead different parts of that organization. But then you have just financial related acquisition strategies, which I think is actually playing to a key benefit longer term to someone like a Mohawk who's product first. Because at the end of the day, you have to maintain your leadership. I mean, some of these products don't just sit there without any continued curation, understand the supply chain, understand the small iterations that are required, understand the marketing capabilities that are required to keep that leading position on search results, the automated pricing, dynamic pricing that is required as well. So again, when you have financial sponsors coming in simply for accretive acquisitions, yes, that's good in the short term for potentially those financial investors, but I do think long term that could be the demise of some of those brands. So there's so many different aspects that are on this platform, but I think we're talking about Mohawk product first, has the capabilities from Amy, which is, again, for me, it's more about a unified platform as opposed to kind of some of the buzzwords like machine learning and AI and some other things. It's really just a centralized place. So that's really how I look at Mohawk from a competitive standpoint relative to who they're competing up against.
So do you think being public puts them in a better position versus competitors?
I mean, I'd say, yeah. Personally, yeah, of course. I think being able to use some of this equity capital that they've been able to use here in the short term, I think has been beneficial to them. Having that equity value that is valued in real time, you could say in some days it's not so exciting, but but for the most part, if you're talking about walking up to a single seller that has one product and you're offering them a small sliver of your company, I mean, talk about a reason to jump on board and kind of be along for the long haul with an organization. And we've seen that over the last acquisitions where they've become, in some cases, meaningful shareholders of the business and kind of grow with them. One little anecdote is, again, I've spoken with a couple Amazon sellers, large. And one of the key things is they don't want to give their baby away. And what's a better way to give your baby away than kind of owning the equity and kind of from a perception standpoint, kind of being along for the ride.
Right. Perfect. Do you guys have anything else before we move on to the last few questions here? Nope.
No,
all right.
I mean, I think that Sean hit it though with regards to being a public company is typically an advantage. And I think that's why we've seen a lot of companies come public via SPAC. They want to get public because they want access to the public markets. They won't be able to use their stock as currency for acquisitions. I mean, even, Porch, for instance, they came public, and as soon as they de-SPAC, they basically announced 4 deals right away. Upstart just came public in December. They just announced an acquisition of a company called Prodigy. So, I think as these companies, there's definitely advantage to being a public company. So I think that works in Mohawk's favor.
All right, perfect. And that rolls right into the concerns and counterpoints. We're going to try to play devil's advocate for any potential shareholders. And we'll start with Sean on this one, because I know on your in-depth write-up, which I think was in August of this year, which you can find on your website pretty easily, you talked about the reliance on Amazon FBA. Are there any worries about relying so heavily on Amazon going forward, and how do you see that evolving?
Yeah, I mean, there's so many aspects to kind of take away there. I mean, one is really ultimately, so you hear that a lot is like, oh, they're on Amazon and there's an issue there. And again, it first understand what's the alignment and what's the interest of Amazon. It's really to serve. We've seen that from their cloud business all the way to their consumer business. I think their mission is we aim to be the Earth's most consumer-centric company. So going against your merchants, which in theory is going against your consumers, I think would be a black eye, specifically in the light of having kind of some of the regulatory potential concerns that are out there today for big tech. Then you have the fact that they're a dominant marketplace. I mean, this isn't the first time. For some reason, this is getting locked into like a Mohawk or some others. But look, if you created an app and you're in iOS and in the App Store, or you're on Xbox or PlayStation, you're a gaming publisher. I mean, you're locked into one or two marketplaces where you have no control, and they kicked Madden off. I mean, there would be a revolt from all NFL fans. if that happened.
Right.
I mean, obviously those have kind of consumerization to them. The other thing I tend to hear is, what if they get too large? And I think that's a silly one because, okay, let's say they get too large. What is too large, right? Is it 10%? Is it 5%? And if we throw the numbers around, is it a $300 billion marketplace? Is it a $600 billion marketplace in 5 years from now? So you're telling me at 5%, they're a $30 billion revenue business.
That's pretty good.
Yeah, it's a pretty bad or good problem to have. And then the last thing, I know I'm taking up a lot, but Amazon Basics and competing against, I know Marketplace Pulse has done a pretty good job at aggregating Amazon Basic products and their search rankings. And what we've seen is a decline in Amazon Basics across their categories, right? In terms of where they rank after a keyword. So I think when you start to put all that together, I think the perception that being on Amazon is a risk, which it is in some ways, right? I mean, there's risk there. But I do think there's an alignment. This isn't the first time this has happened. If they do get too big, that's a good problem to have. And Amazon Basics, you don't have to be the number one product on a keyword. You just have to land in the first top 5 and be kind of in the cereal aisle and be kind of eye level. That's essentially what we're talking about here.
Asher, Jonah, any follow-ups to that?
Yeah, I mean, I like Sean said, I mean, there's definitely a risk to being so reliant on Amazon, but there's also a lot of advantages to being so reliant on Amazon since they're the largest e-commerce marketplace in the world. I mean, I like that. I like their reliance on Amazon versus if they weren't on Amazon and they were just running all their own Shopify stores and they had to worry about all of their own, lead gen, customer acquisition themselves. True. I mean, I think the amount that they give up to be part of Amazon is worth it. So, yeah, I mean, I do worry about Amazon getting more heavily into their private label business, but I also do think that they realize the politicians are watching over them, and if they start to screw over their merchants and put their private label products at the top in all search results, Jeff Bezos or whoever the new CEO is will be back in front of Congress pretty quickly. So.
Definitely agree.
Okay. What about, we try to sort of look at the downsides with our investments. So I guess what could go wrong here? What do you guys see as the potential risk with this investment? I mean, I guess just how would you track or how would you know if this wasn't going according to plan? Sean, feel free to start.
Yeah, I mean, look, I'll tell you too, one has always been the case, and that's actually come down quite a bit. Honestly, the biggest risk when we first made our investment was product diversification. So we knew that there was 20% of the revenue roughly making, 20% of the products making roughly 80% of the revenue. That's a risk, right? So what we've seen is these series of acquisitions, which are accretive in nature, but also reducing the dependency on a single product. I think so that risk in itself has come down. The second risk for me is really around execution risk. And again, there's always execution risk, no matter the business, no matter anything. But when you are patching on many of these acquisitions at this speed, and I'm assuming potentially the flywheel increases at some point, there's risk to that. So there's execution risk with supply chain because these are physical goods and getting them from warehouse to home, I think is an important risk to consider. Now, how are we monitoring this stuff? Well, the reality is there's APIs for all of this Amazon stuff out there, and we're tracking almost every product that they have. So that's our risk management. And if you've seen me on Twitter, I'm posting all types of products that are previously announced. Right now they have the Rift 6 brands not on Amazon, some of them not on Amazon, and actually the launch of some of their exercise equipment like the punching bag and the rower are sitting on Walmart Marketplace prior to being on Amazon. And I thought that was an interesting phenomenon. I hadn't seen that previously. So we'll see. I mean, those are kind of how we're tracking some of these risks that are out there.
I mean, one of the things I think about, and I haven't heard management actually say this specifically, but I think a lot of their products prior to the M&A strategy were it was a lot of home goods, but it was also a lot of like one-time buys. And I think as they move more into M&A, I think they want to try to find products where it's more of a, subscription or recurring revenue stream. I mean, we all like half of the stuff that I buy off Amazon is just set up for auto ship. I get it every 2 weeks, 3 weeks, 4 weeks, however I set it up. I think Mohawk is going to hopefully start pushing harder in that direction, just so it's more predictive revenue going forward.
Okay. Asher, how about you?
I agree. Another risk that no one's mentioned yet is China. There's a lot of Chinese manufacturing involved, like with every other consumer goods product and consumer goods company in the world. So I think we're good there, but if there was, there's always that exposure. Obviously, they went through what I would think would be the worst of it with, the trade war that we had a few years ago, and didn't really affect them. But that's another one out there.
Okay.
True.
You got any more questions?
I think that's it. I can't add anything to this.
Okay. All right. Well, so for any listeners, where can they find you? We'll start with Sean.
On Chit Chat Money. No, on Twitter. I'm sure you'll see us on Chit Chat Money's tweet when they throw this out there, and I think it's _ Sean David. Got to remember that one. Yeah, so that's where you can find me.
And there's also a good write-up on Mohawk if you want to read about it on Sean's website. I think it's averyco.com. Am I getting that right?
Avery.xyz. So we didn't want to pay the $60,000 for .com, and Google went with XYZ, so we thought it was cool.
There we go. All right.
Jonah, Asher, what about you guys?
Yeah, you can find me on Twitter, just my first name, last name, so at Jonah Lupton. And then in my bio, there's some links to my websites and newsletters and stuff that you can sign up for.
Perfect.
Asher?
Twitter.
Okay.
Yep.
All right.
All right. Thank you, guys. I appreciate the time. Thanks for coming on.
Yeah, it was really fun.
Got it. Thanks for having me.
Thanks. It was a pleasure, guys.